Chapter 1. Think like Buffett or stay broke. You have a choice. Right now, at this very moment, you can continue thinking like everyone else, or you can start thinking like Warren Buffett. And that difference, thinking like Buffett versus thinking like the crowd, is the difference between wealth that compounds over decades and income that disappears month after month. That's the key. The real question is not whether you're smart or lucky. It's whether you're willing to see what others ignore, to act when others hesitate, and to commit to a mindset that transforms small decisions into extraordinary results over time. Warren Buffett's success is about patterns, mental patterns, financial patterns, and behavioral patterns that compound relentlessly. He didn't stumble into fortune. He didn't chase fads. He reprogrammed his brain for long-term advantage. And if you want to follow the same path, you need to start doing the same. Buffett's approach begins with mental models over memorization. Not because facts aren't useful, but because patterns matter more than numbers on a page. You might think investing is about charts, reports, or insider tips, but in reality, it's about recognizing repeatable behaviors. Consider Buffett's investments in Coca-Cola and Apple. Both were undervalued in ways that the majority ignored. Coca-Cola in the late 1980s was a global brand with consistent cash flow. Apple, more recently, offered products people didn't even know they needed, but the business fundamentals were undeniable. Buffett didn't make these investments on a whim. He analyzed patterns in human behavior, company leadership, and long-term financial health. He trained his mind to see value where others saw risk. This is about more than spotting opportunities. It's about rewiring your thinking to anticipate compounding results. The more important issue is time. Buffett doesn't just buy a stock, he buys years of compounding growth. Time is leverage. Patience is power. You don't need their permission to take this approach. You don't need Wall Street certification or billionaire portfolio to start thinking like this today. The principles are accessible to anyone willing to see past short-term noise. And noise there is. The world screams at you constantly. Buy now. Sell now. Don't miss out. Buffett's first lesson is, ignore the noise. Think long-term. Act decisively. Ignore noise. Repeat it. Say it aloud. Let it sink into every decision you make. You might think reacting quickly shows intelligence, but in reality, intelligence is often revealed in restraint. From 1965 to 2020, Berkshire Hathaway's compounded annual growth rate was approximately 20%. Not because Buffett chased the trend, but because he waited, observed, and acted when value revealed itself clearly. You have a choice every day. You can follow the headlines, the crowd, the hot stock, the expert advice that floods the internet. Or you can follow principles that multiply quietly, steadily, relentlessly. It's not about being flashy, it's about being consistent. Consistency beats brilliance every single time. Buffett famously said, "The stock market is designed to transfer money from the active to the patient." Not because the active lack effort, but because patience and pattern recognition outperform impulsive action. That's the kind of thinking you need to internalize. Now, let's translate these principles into action for you. First, start practicing pattern recognition in your own life. Not just in stocks, but in the opportunities around you. Which habits compound wealth in your career? Which relationships compound influence in your social network? Which daily choices compound health, energy, and confidence? You don't need their permission to invest in yourself. Just as Buffett studies businesses relentlessly, you must study your own environment relentlessly. Observe what grows and what decays, and make your decisions based on logic and data, not hype or emotion. Second, train your patience. This is harder than it sounds. Human brains are wired for instant gratification. The world rewards speed and drama, but wealth, real wealth, rewards consistency over time. Buffett has said, "The big money is not in the buying and selling, but in the waiting." This isn't the end. It's the beginning of a lifetime of compounding advantage. Whether you like it or not, learning to wait, to analyze, to act decisively when the opportunity is clear is non-negotiable. Third, apply repetition to cement your mindset. Think long-term. Act decisively. Ignore noise. Repeat it. Write it down. Say it aloud. Let it guide your decisions until it becomes automatic. The brain is a habit machine. Feed it the right signals, and it will produce the results you want. This is about more than investing. It's about creating a mental framework that guides every choice, from money to career to relationships. You'll notice over time that opportunities that used to intimidate you now appear obvious. Risks that once paralyzed you now seem manageable. That's the power of thinking like Buffett. Not only does this mindset change your approach to wealth, but it changes your life entirely. You stop chasing approval. You stop seeking instant validation. You stop reacting to fear and greed around you. The real question is not whether you can make money, but whether you can think differently and act differently than the crowd. Buffett didn't wait for permission to invest, and neither should you wait for permission to think. Finally, let's talk about decision-making clarity. Buffett's key strategy is saying no more than yes. He evaluates every opportunity ruthlessly. The opportunities you pursue should meet the same standard. Ask yourself, does this move create long-term advantage, or does it satisfy short-term impulse? Does it compound, or does it vanish quickly? If the answer isn't clear, wait. Don't just take my word for it. Look at Berkshire Hathaway's portfolio. Buffett invests in companies he understands deeply, and he avoids speculation entirely. That focus allows him to allocate capital where it will grow the most over decades, not weeks or months. So here's your actionable takeaway for this chapter. Train your mind for patterns, not hype. Look at opportunities as you would analyze a business, not a headline. Practice patience daily. Recognize that real growth takes time, and resist the urge to act impulsively. Reinforce your mindset repeatedly. Think long-term. Act decisively. Ignore noise. Let it guide every decision. Chapter 2. Ignore the herd, follow the logic. You have a choice. Every single day, the world bombards you with noise, opinions, and so-called expert advice. Whether it's the stock market, business decisions, or even personal choices, the majority will follow the crowd. The real question is not whether the crowd is loud, it's whether you will let them dictate your decisions. That's the key. Far from being harmless, following the herd can destroy opportunities before you even recognize them. Warren Buffett built his fortune not by joining the majority, but by seeing what others ignored and acting decisively when others panicked. Consider the 2008 financial crisis. Everyone around the world was screaming, selling, and panicking. Banks failed. Investors lost trillions. The media plastered fear everywhere. You might think that in times like these, safety lies in following the herd. But in reality, the herd is almost always wrong at exactly the moments that matter most. Buffett didn't follow the panic. He didn't react to headlines. He focused on logic, fundamentals, and value. This isn't the end. It's the beginning of understanding a principle that separates billionaires from the masses. Independent analysis beats consensus every single time. Not only does ignoring the herd prevent mistakes, but it also positions you to seize opportunity. The more everyone talks, the more I focus. That is Buffett's mantra. You don't need their permission to see value others overlook. You don't need approval from analysts or media pundits. What we need is not to blend in with the noise, but rather to develop clarity in our own thinking. And that clarity starts with asking the right questions. What is the intrinsic value here? What will this look like in 5, 10, or 20 years? Am I acting from logic or from fear? Buffett has repeatedly emphasized this. He said, "Be fearful when others are greedy and greedy when others are fearful." Not because fear and greed are emotions to eliminate entirely, but because they distort perception. If we don't recognize how the crowd behaves under pressure, then we risk losing the advantage that patience and independent thinking create. Far from being counterintuitive, this strategy is straightforward. Focus on logic, not headlines. Analyze fundamentals, not opinion. Act when opportunity is clear, not when pressure is loud. Let's translate this into actionable steps for your own life. Step 1. Develop your own framework for analysis. Buffett doesn't guess. He evaluates. He studies businesses, financial statements, leadership teams, and market trends. You can apply the same principle to any decision in your life. Don't just take my word for it. Look at Buffett's investment in American Express during a financial scandal in the 1960s. While the public panicked and sold shares, Buffett recognized that the company's fundamentals remained strong. That analysis created extraordinary long-term returns. Apply this principle. Don't assume failure because everyone else is panicking. Look at the facts. Draw your own conclusion. Step 2. Question conventional wisdom. The more conventional, the more crowded. And crowded markets lead to subpar results. Buffett once said, "The difference between successful people and really successful people is that really successful people say no to almost everything. Not because opportunity is scarce, but because clarity and focus are rare." You might think opportunity is everywhere, but in reality, it is clarity and patience that determine which opportunities matter. Whether you like it or not, saying no is as important as saying yes. Every decision you make compounds over time. Missteps are amplified when they are influenced by the herd. Step 3. Practice detachment from emotion. The herd reacts to emotion, fear, greed, envy, and panic. You must react to logic. This is about more than money. It's about training your mind to evaluate situations objectively. Not only will this make you a better investor, but it will also make you a better decision-maker in life, career, and relationships. Just as Buffett isolates value in business, so too can you isolate clarity in your own choices. Ask yourself, am I reacting to pressure or am I reacting to principle? Step 4. Use repetition to internalize this habit. The audiobook mantra is simple. The more everyone talks, the more I focus. Repeat it. Let it guide your decisions. Reinforce it daily. Let it influence not only your financial choices, but your habits, your career strategy, and your personal development. The more you practice, the easier it becomes to see through panic, hype, and noise. Far from being difficult, independent analysis becomes intuitive once you commit to it. Let's bring this home with a practical exercise. Pick a decision you are facing, an investment, a business idea, or even a career move. Write down what everyone around you is saying. Then, write down what the data, facts, and patterns actually suggest. Don't stop until you've created a clear, independent evaluation. This is exactly what Buffett does with every investment he makes. You don't need Wall Street experience to start applying this today. You don't need permission. You only need the discipline to follow logic over opinion, facts over noise. Not only does this habit prevent mistakes, but it also positions you to capitalize on opportunities no one else sees. Think about Buffett's acquisition of Berkshire Hathaway itself. Originally a struggling textile company, the public had written it off. Buffett saw value, applied logic, and acted decisively. Decades later, it became one of the most profitable and diversified companies in the world. That's the power of independent analysis. That's the difference between following the herd and following your logic. The more important issue is mindset. Independent analysis is not a skill you develop overnight. It requires constant practice, constant reinforcement, and constant questioning of conventional wisdom. It's easy to say, ignore the crowd, but harder to act on it when panic, pressure, and social proof pull you in another direction. This is about more than investing. It's about building a mental discipline that compounds over time, just as your wealth will when guided by logic rather than noise. You have a choice. Every day, you can follow the herd, react impulsively, and make decisions that dissipate your advantage. Or you can follow Buffett's approach, evaluate logically, act decisively, and ignore the crowd. Remember the mantra, the more everyone talks, the more I focus. Repeat it, internalize it, let it guide your life. By now, you've learned that wealth isn't about luck. It's about discipline. It's about clarity. It's about acting decisively while others panic. You've mastered ignoring the herd, but there's another layer to true wealth creation: patience. You've seen how independent analysis multiplies opportunity, but without patience, even the clearest decision can fail. Chapter 3. Master the power of patience. You have a choice. Every moment, you can chase speed, instant gratification, and quick wins, or you can embrace patience. That's the key. Far from being passive or weak, Patience is a weapon. Time is your secret weapon. Warren Buffett didn't become the Oracle of Omaha by rushing, by chasing trends, or by trying to get rich quickly. His wealth grew slowly at first, compounded quietly over years, and then exploded with unstoppable force. The real question is not whether you can wait. It's whether you can wait with discipline, focus, and strategic insight. Buffett himself has said, "The stock market is a device for transferring money from the impatient to the patient." Not because the impatient lack intelligence, but because patience multiplies advantage. It's disciplined. It's a mindset that guides every decision you make. And if we don't master patience, then we risk squandering opportunity, making impulsive moves, and letting time slip through our fingers. You might think that fast action is always superior. In reality, speed is often the enemy of wealth. That's why Buffett repeats this mantra: fast is the enemy of wealth. Slow is the ally of fortune. Not because action isn't important, but because strategic waiting ensures that when you act, your decisions compound over decades instead of weeks. Just as Buffett waits for the right company, the right price, and the right leadership, so too must you wait for the right moment in your own life, career, and investments. Let's break this down into concrete steps. Step 1. Practice selective action. Patience does not mean inaction. It means acting only when conditions align with long-term advantage. Buffett ignored hot stocks, fads, and market hysteria, even when friends and media pressured him to jump in. For example, he passed on early tech mania stocks like Microsoft in the 1980s, not because he was short-sighted, but because he didn't understand the business enough to invest confidently. Patience allowed him to focus on investments where he could truly assess value. You don't need their permission to wait. You only need the discipline to recognize when the timing is right. Step 2. Embrace the power of compounding over time. Buffett famously said, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." Not because luck is universal, but because compounding rewards those who wait, reinvest, and act consistently over decades. This isn't the end. It's the beginning of understanding that your time horizon is more powerful than your speed. Every small, smart choice you make today compounds quietly while the impatient chase short-term gain. Step 3. Reframe your perception of waiting. Most people see waiting as wasted time. Buffett sees waiting as leverage. He invests in businesses with strong fundamentals and then allows them to grow. He doesn't panic when the market dips or when others sell. Far from being stressful, patience creates clarity. The more important issue is mindset. Impatience creates anxiety, fear, and poor decisions. Patience creates confidence, insight, and the ability to act decisively when the moment is optimal. Step 4. Internalize auditory reinforcement. Repeat it aloud. Fast is the enemy of wealth. Slow is the ally of fortune. Repeat it in your mind every time you feel pressure to act impulsively. Let this phrase guide your decisions about investments, career moves, and even personal goals. Not only will this repetition help you resist short-term temptation, but it will also transform your perception of opportunity. You will begin to see value where others panic. You will begin to act decisively while others hesitate. Let's consider real examples. Buffett's investment in Coca-Cola in 1988 illustrates patience perfectly. While many investors ignored the stock because it wasn't exciting, Buffett studied the company's long-term potential, evaluated its brand, and patiently acquired shares over time. Decades later, that patience created billions. Don't just take my word for it. Look at Berkshire Hathaway's portfolio growth. Every investment reflects this principle. Patience compounds advantage, impulsive action destroys it. It's easy to say, "I can wait," but harder to resist the pressure of the crowd, the hype, and the fear of missing out. That's why you need behavioral strategies. Create mental rules for yourself. Invest only when you understand the opportunity deeply. Wait until conditions are favorable. Resist the urge to chase short-term trends. Not because you are cautious, but because discipline over impatience produces results that outlast generations. Step 5. Apply patience beyond investing. This isn't just about stocks or financial markets. It's about decisions in business, relationships, and personal growth. The same principle applies. Do not act impulsively. Wait, observe, analyze, then act decisively. Just as Buffett waits for the right company, the right price, and the right leadership, so too must you wait for the right conditions in your life. Far from being passive, this strategy compounds advantage across every area of your life. Step 6. Learn from missed opportunities. Not all patience leads to success, but rushing almost always leads to loss. Buffett has openly admitted to passing on stocks like Google and Amazon early in their growth, not because he lacked vision, but because the timing didn't match his understanding of the business. He waited for clarity. That is a lesson you can apply today. Not every opportunity is yours to take. Just as Buffett avoids impulsive purchases, you must avoid impulsive actions that destroy value. You have a choice in every decision. You can chase the next trend, succumb to impatience, and react to noise, or you can wait, analyze, and act when the moment compounds advantage. You don't need their permission to be patient. You don't need approval from anyone. Patience is your tool, your secret weapon, your path to compounding wealth and influence. The more important issue is consistency. Patience must be repeated daily. Every decision is an opportunity to exercise it. Every impulse is a test of it. Every moment of restraint compounds into long-term advantage. You might think patience is boring, but in reality, it's the engine behind every great fortune, every successful career, and every lasting achievement. To summarize your actionable takeaways from this chapter, act selectively. Only move when conditions align with long-term advantage. Leverage time. Use patience to compound results quietly, steadily, and consistently reinforce mentally. Repeat the mantra, fast is the enemy of wealth. Slow is the ally of fortune. Chapter 4. Find true value where others don't. You have a choice. Every time you look at a business, an investment, or an opportunity, you can see the surface or you can see the substance. That's the key. Far from being obvious, true value is often hidden behind chaos, fear, and short-term volatility. Warren Buffett didn't get rich by buying what everyone else was buying. He didn't follow price tags. He followed value. And if you want to follow the same path, you need to learn to distinguish price from value. Buffett famously said, "Price is what you pay. Value is what you keep." Not because the stock market is a casino, but because the market often misprices what matters most. You might think that paying less guarantees profit. In reality, paying less for something that lacks long-term value is still a loss. Conversely, paying a fair price for something with immense value compounds wealth quietly, steadily, relentlessly. This is about more than investing. It's about seeing beyond surface impressions and uncovering hidden opportunity in every decision you make. The real question is not whether something looks cheap, it's whether it will create lasting value. Consider Buffett's investment in American Express during the 1960s. The company faced a scandal that sent its stock plummeting. Panic gripped the market. Most investors ran for the exits. Buffett didn't. He analyzed the company's fundamentals, brand strength, long-term profitability, and market positioning. He recognized intrinsic value where others only saw fear. That is the essence of finding value. Separating noise from substance, speculation from reality, price from potential. Not only does this skill protect you from mistakes, but it positions you to capture massive upside when the crowd panics. The more important issue is discipline. Buffett doesn't chase excitement. He doesn't buy because a stock is trending. What we need is not impulsive buying, but rather careful, data-driven evaluation. He looks at balance sheets, income statements, and cash flow, and he evaluates leadership quality. He asks, can this company survive downturns? Will it generate profits 10 years from now? Will it continue growing even if the market forgets about it? If the answer is yes, he invests. Let's break this down into practical steps. Step 1. Learn to read financial statements. You don't need an MBA, but you do need the discipline to understand revenue, profit margins, debt levels, and cash flow. Buffett looks for companies with predictable earnings, strong competitive advantages, and competent management. Not because he's looking for a quick flip, but because these companies compound value over time. Apply this principle to your own life. When evaluating an opportunity, focus on fundamentals, not hype. Ask yourself, does this have intrinsic worth that will endure? Step 2. Evaluate leadership. Buffett invests in people as much as in companies. He studies the managers, the executives, and the culture of the business. He wants leaders with integrity, intelligence, and accountability. Far from being a trivial factor, leadership determines whether value is maintained or destroyed over time. The more important issue is that many investors ignore this completely, focusing only on price movements. Don't make that mistake. Value is often hidden in leadership that others overlook. Step 3. Detect hidden value. Not all assets are obvious. Buffett looks for businesses with untapped potential, undervalued brand recognition, or opportunities to generate cash flow quietly. For example, Berkshire Hathaway acquired companies that seemed mundane: textiles, insurance, and consumer products. But over decades, these acquisitions delivered enormous returns. The principle is clear: value is rarely flashy. It often lies in stability, resilience, and underappreciated assets. You don't need their permission to see what others miss. Train your eye to look beyond surface numbers and headlines. Step 4. Apply the mantra repeatedly. Say it aloud: price is what you pay. Value is what you keep. Repeat it whenever you evaluate a stock, a business, a deal, or even a personal decision. This mantra is not just about money. It's a principle that applies to every resource you control: time, energy, attention, relationships. Ask yourself, am I investing in what truly compounds, or am I distracted by temporary noise? This isn't easy, but it's essential. Just as Buffett's wealth compounded quietly while the world chased fads, so too can your results compound when guided by discipline and value. Step 5. Practice patience alongside valuation. Finding value is useless if you act impulsively. Buffett waits for the right price, the right context, and the right opportunity. He doesn't buy just because he sees value. He buys when value aligns with opportunity. Not only does this prevent mistakes, but it also multiplies your returns. You might think opportunity is rare. In reality, value exists everywhere if you know how to look, and patience is what allows you to capitalize on it. Step 6. Apply independent thinking. No one can deny that market sentiment affects prices, but what's often overlooked is that sentiment rarely affects intrinsic value. The crowd often panics, underestimates, or misprices. Buffett thrives in these moments. He doesn't react emotionally. He analyzes, he evaluates, and then he acts decisively. Far from being risky, this approach minimizes risk and maximizes opportunity. The more everyone is fearful, the more you should focus. Repeat that principle mentally every day. Let's consider another example: Apple. Buffett began investing when many investors were skeptical about a tech company outside his usual expertise. Yet he evaluated Apple's brand, cash flow, and loyal customer base. He saw long-term value hidden from the masses, not because he had insider knowledge, but because he focused on fundamentals. That is the essence of this chapter: learning to see what others ignore, acting decisively, and holding investments that compound over time. The actionable steps for you are clear. Analyze fundamentals. Revenue, earnings, debt, and growth trends matter far more than headlines or hype. Evaluate leadership. Integrity, competence, and vision protect and grow value. Detect hidden value. Look for opportunities the crowd overlooks. Patience amplifies this advantage. Internalize the mantra: price is what you pay. Value is what you keep. Let it guide every decision. Exercise independent thinking. Ignore the panic. Focus on what matters. You have a choice. Every day, you can chase price or you can focus on value. You don't need anyone's permission to see the long-term advantage. You don't need approval from a crowd, the media, or your peers. Value compounds quietly. Noise dissipates quickly. The more you internalize this principle, the more every decision you make will align with long-term advantage. Chapter 5. Risk is a choice, not an accident. You have a choice. Every time you make a financial decision, a business move, or even a personal life choice, you can either treat risk as something to fear or you can treat it as something to understand. That's the key. Far from being a random force, risk is predictable if you know how to analyze it. Warren Buffett didn't become one of the richest people in the world by avoiding risk. He became rich by understanding risk, evaluating it, and acting decisively when the odds were in his favor. The real question is not whether risk exists, it's whether you are equipped to handle it intelligently. Buffett famously said, "Risk comes from not knowing what you are doing." Not because the world is inherently dangerous, but because unprepared people expose themselves to avoidable loss. Far from being luck, his approach is methodical. He doesn't guess. He doesn't speculate blindly. He studies businesses, evaluates opportunities, and identifies what is safe versus what is reckless. Whether you like it or not, acting without knowledge is the riskiest move you can make. Repeat that to yourself. The riskiest move is acting without knowledge. Let it guide every decision you make. The more important issue is mindset. Most people conflate risk with danger, assuming that avoiding it completely is wise. In reality, the only way to grow wealth, influence, or skill is to take calculated risk. The real question is not how to eliminate risk, but how to manage it. That requires discipline, analysis, and patience. Buffett doesn't avoid risk, he redefines it. Risk isn't about volatility. Risk isn't about fear. Risk is about the probability of permanent loss, and understanding that distinction is crucial. Step 1. Assess intrinsic risk versus perceived risk. The world often exaggerates short-term fluctuations, market noise, or hype around an investment. Buffett looks past these distractions. He evaluates the true, underlying value of a business, asking, can this company survive economic cycles? Will it generate cash flow 10 years from now? If the answer is yes, the risk is manageable. If the answer is no, it's a gamble. The more important issue is clarity. Don't confuse temporary fear with true danger. Step 2. Focus on knowledge as your risk shield. Buffett's principle is simple. The more you know, the less risky an opportunity becomes. You don't need their permission to educate yourself. You don't need to follow advice blindly. Study financial statements. Analyze leadership. Understand competitive advantage. Evaluate long-term trends. Not because knowledge guarantees success, but because it reduces uncertainty and increases your ability to act decisively. Just as Buffett studies businesses, so too must you study every decision before committing. Step 3. Separate speculation from investment. Buffett often says, speculation is when you don't know what you're doing. Investment is when you do. Far from being a philosophical distinction, this is practical. Buying a stock because the headline says hot is speculation. Buying a company because you understand its value, leadership, and long-term growth is investment. You have a choice. You can gamble or you can invest. The riskiest move is acting without knowledge. Repeat it again. The riskiest move is acting without knowledge. Let it guide your behavior daily. Step 4. Analyze worst-case scenarios. Buffett doesn't rely on hope or optimism. He prepares for the downside. He asks, what is the maximum loss I could sustain? Can I survive it? Will I be able to wait for recovery? Far from being negative, this step gives clarity and confidence. The more prepared you are for the worst case, the less risky the opportunity becomes. Not because you are paranoid, but because you are disciplined. Buffett's Berkshire Hathaway survived multiple market crashes precisely because he accounted for risk at every stage. Step 5. Leverage margin of safety. This is a concept Buffett learned from his mentor Benjamin Graham. It's simple. Buy with a buffer between price and intrinsic value. If you estimate a company is worth $100 per share, don't pay $100. Pay $70 or $80. Not only does this reduce potential loss, but it also multiplies potential gain. Far from being cautious, this is an active strategy to manage risk while maximizing opportunity. You might think high returns require high risk, but in reality, disciplined evaluation and margin of safety outperform reckless bets every time. Step 6. Ignore emotional triggers. The market, the media, and social pressure create fear and greed. Buffett doesn't react emotionally. He doesn't panic. He doesn't chase hype. Instead, He analyzes logic and acts decisively. This isn't the end. It's the beginning of mastering risk as a tool, not a threat. The riskiest move is acting without knowledge, and every time you act emotionally, you multiply risk unnecessarily. Step 7. Transform risk into opportunity. Buffett thrives in situations where others fear loss. The 2008 financial crisis is a prime example. While others panicked, Buffett evaluated banks with strong fundamentals and acquired them at distressed prices. What was terrifying to the public became a strategic advantage for him. Not because he was reckless, but because he understood the risk thoroughly. Far from being coincidental, this is replicable. Knowledge, analysis, and discipline turn risk into advantage. Step 8. Apply risk principles to your life beyond investing. This isn't just about money. Every important decision, career moves, business partnerships, major purchases, relationships, carries risk. Apply the same discipline. Study, analyze, and act only when your understanding outweighs uncertainty. The more everyone is panicking, the more you should focus on facts. Not because risk disappears, but because your disciplined approach ensures the upside outweighs the downside. Let's summarize your actionable takeaways from this chapter. Assess true risk, not perceived risk. Look beyond fear and headlines. Educate yourself relentlessly. Knowledge is your shield. Differentiate investment from speculation. Act only when you understand the opportunity. Plan for the worst case. Be prepared. Reduce exposure. Increase confidence. Use margin of safety. Protect yourself while positioning for maximum upside. Ignore emotional triggers. Discipline, not panic, guides wealth. You have a choice. You can let fear dictate your actions, or you can master risk as a calculated tool. You don't need anyone's permission to analyze carefully. You don't need the approval of friends or media pundits. The riskiest move is acting without knowledge. The safest move is acting with preparation, understanding, and discipline. Chapter 6. Build influence through integrity. You have a choice. Every interaction, every agreement, every business decision you make either builds or erodes your reputation. That's the key. Far from being abstract, your reputation compounds like capital. Warren Buffett has repeatedly emphasized this principle. He doesn't rely on force, intimidation, or flashy marketing. He relies on trust, credibility, and integrity. And if you want to build influence that lasts, you must treat your word as your most valuable asset. Buffett famously said, "It takes 20 years to build a reputation and 5 minutes to ruin it." If you think about that, you'll do things differently. Not because reputation is fragile, it is, but because reputation is leverage. Far from being optional, integrity is the currency of influence. You don't need anyone's permission to behave honorably. You don't need validation from peers or authority figures. Whether you like it or not, people notice. They remember. They act on your reliability. The more important issue is that influence without integrity is temporary. You might think charisma, persuasion, or social media presence is enough. In reality, these are fleeting. Real influence compounds over time, just like capital, when it is anchored in trust. Buffett demonstrates this through decades of shareholder letters, partnership agreements, and business deals that prioritized honesty over hype. Not only does integrity build influence, but it also reduces risk. People are more likely to give you opportunities, negotiate fairly, and collaborate with you when they know your word is reliable. Step 1. Treat your word as capital. Buffett's mantra is simple. Your word is your capital. Protect it fiercely. This means what you promise, you deliver. What you commit to, you honor. Not because others will reward you immediately, but because integrity compounds over time. Each act of honesty, reliability, and consistency strengthens your influence. Each breach weakens it exponentially. You have a choice. You can take shortcuts, or you can act with discipline and build influence that lasts. Step 2. Communicate transparently. Buffett writes annual letters to shareholders not to impress, but to educate, clarify, and build trust. He shares wins, failures, and reasoning in detail. Far from being promotional, This transparency creates loyalty and credibility, not because he needs approval, but because he knows clarity and honesty multiply influence over time. The real question is not whether people will like your decisions. It's whether they will trust you to act ethically, strategically, and consistently. Step 3. Choose partners wisely. Buffett famously structured deals with clear, fair terms that respected all parties. He avoids adversarial tactics. Far from being naive, this strategy multiplies opportunity. People want to work with those who honor commitments. People avoid those who cut corners. Not only does integrity attract collaborators, but it also repels unnecessary risk. Just as capital compounds in the market, your influence compounds in networks, relationships, and industries when guided by integrity. Step 4. Demonstrate consistency. Reputation isn't built overnight. Buffett's decades-long record shows that consistent behavior creates trust. He avoids impulsive actions, rash statements, or shortcuts. Every decision reflects his principles. Far from being optional, consistency multiplies influence. You might think one impressive deal or statement is enough. In reality, long-term credibility is earned by repeated, disciplined behavior over years. Step 5. Use influence responsibly. Buffett leverages influence without intimidation. He doesn't pressure, manipulate, or coerce. Instead, he educates, advises, and leads by example. This is about more than appearances. It's about creating environments where others want to follow you because they trust your judgment. Not because they fear you, but because they know your word has value. The more important issue is that influence built without integrity is fragile. Influence built with integrity is unstoppable. Step 6. Learn from failures and admit mistakes. Buffett openly acknowledges mistakes in shareholder letters, analyzing what went wrong and what was learned. Far from weakening his influence, this transparency strengthens it. People respect honesty. People trust self-awareness. You don't need their permission to admit error, but you do need the discipline to do so consistently and constructively. Not because admitting mistakes is easy, but because it builds credibility that multiplies opportunity. Step 7. Apply integrity to every area of life. This isn't just about business. Every interaction, personal relationships, professional networks, social commitments, benefits from a reputation of reliability. Every contract, promise, and task compounds your credibility. Far from being abstract, these choices determine long-term influence, access, and opportunity. You might think small promises unimportant. In reality, they are the foundation upon which massive influence is built. Step 8. Reinforce mentally and audibly. Repeat the mantra, your word is your capital. Protect it fiercely. Let this guide your decisions, behavior, and communication. Let it influence how you approach negotiations, leadership, and collaboration. Far from being theoretical, this phrase is actionable. Every time you honor your word, your influence grows. Every time you break it, you risk opportunities that could take decades to rebuild. Step 9. Leverage integrity for compounding opportunity. Buffett doesn't use his reputation for ego or publicity. He uses it to create leverage. Partnerships, acquisitions, and strategic moves flow from trust. Not because others are naive, but because consistent integrity reduces friction, builds goodwill, and multiplies opportunity. The more people know they can rely on you, the more doors open, the more deals materialize, and the more options become available. Step 10. Teach and influence others ethically. The most enduring influence comes from creating a legacy of trust. Buffett shares lessons in shareholder letters, interviews, and speeches. Far from being self-serving, this multiplies his influence exponentially. You don't need permission to share knowledge, but you do need discipline to share it with integrity. Influence built ethically compounds across people, industries, and generations. Let's summarize your actionable takeaways from this chapter. Protect your word fiercely. Every commitment matters. Communicate transparently. Build trust through honesty and clarity. Choose partners wisely. Integrity attracts opportunity and reduces risk. Be consistent. Long-term credibility multiplies influence. Admit mistakes. Transparency strengthens trust. Apply integrity broadly. Every decision contributes to your reputation. Leverage your influence ethically. Multiply opportunities without manipulation. You have a choice. You can chase shortcuts, hype, and shallow persuasion. Or you can commit to integrity, discipline, and consistent reliability. You don't need anyone's permission to behave honorably. Your word is your capital. Protect it fiercely. Far from being optional, this principle compounds opportunity, influence, and success across every area of your life. Chapter 7. Invest in yourself first. You have a choice. Every day, you decide how to spend your most valuable resource, yourself. That's the key. Far from being abstract, the best return on investment you will ever receive comes not from stocks, bonds, or real estate, but from investing in your own skills, knowledge, and habits. Warren Buffett has said it clearly: the best investment you can make is in yourself. Not because he is self-centered, but because self-investment compounds faster and more reliably than any other asset. Whether you like it or not, your personal growth dictates your wealth, influence, and freedom. Buffett emphasizes not just knowledge, but decision-making skills. He believes it is easy to learn facts. The challenge is learning to think clearly and make better decisions under pressure. The more important issue is that most people ignore this principle. They chase external opportunities while neglecting the most powerful asset they own, themselves. Far from being a luxury, investing in yourself is a prerequisite for every opportunity you want to capitalize on. You don't need their permission to become smarter, stronger, and more disciplined. Step 1. Read relentlessly. Buffett reportedly spends 5 to 6 hours every day reading books, reports, and newspapers. Not because reading is a hobby, but because it builds a knowledge base that enables intelligent action. Far from being passive, this is an active investment in your mental capital. Don't just read headlines. Analyze case studies. Understand history. Study business principles. Just as Buffett reads to compound knowledge, so too must you invest in consistent, focused learning. Repeat to yourself, the best stock I can buy is myself. Say it aloud. Let it guide every hour of your day. Step 2. Develop critical skills. Knowledge without skill is useless. Buffett invests in skills that enhance his decision-making, financial analysis, pattern recognition, strategic thinking, and risk assessment. The real question is not how much you know, but what you can do with what you know. Far from being theoretical, these skills multiply opportunity. Whether you're negotiating a deal, evaluating a business, or making career choices, skill compounds like interest on capital. You have a choice. You can stay static or you can invest in capabilities that grow exponentially. Step 3. Seek mentorship. Buffett often credits his success to guidance from mentors like Benjamin Graham and Charlie Munger. Far from being optional, mentorship accelerates learning by compressing years of trial and error into actionable insights. You might think you can figure everything out alone. In reality, guidance from experienced mentors is one of the fastest ways to increase personal ROI. Not because mentors will do the work for you, but because they illuminate pitfalls and opportunities you cannot see on your own. This is about more than advice, it's about strategic acceleration of your growth. Step 4. Build disciplined habits. Buffett doesn't just read and learn occasionally, he practices daily habits that compound over time. This includes consistent reading, structured thinking, deliberate analysis, and continuous self-reflection. Not only does habit reduce mental friction, but it ensures growth compounds quietly while others chase fleeting trends. Far from being rigid, these habits create flexibility, foresight, and resilience in decision-making. The real question is not what habits are easy, but which habits create the largest long-term return. Step 5. Invest in your health. Buffett famously emphasized the importance of well-being, noting that without health, wealth is meaningless. Far from being motivational fluff, physical and mental health compound your ability to act, think clearly, and execute effectively. You might think skipping exercise or ignoring nutrition is harmless. In reality, it erodes your capacity to capitalize on every opportunity. Whether you like it or not, your body and mind are part of your investment portfolio. Protect them. Optimize them. Prioritize them. Step 6. Practice reflection and evaluation. Buffett dedicates time to review decisions, successes, and failures. Far from being self-indulgent, this practice identifies mistakes early, reinforces effective patterns, and strengthens judgment. You don't need their permission to reflect. You don't need validation for self-assessment. Repeat this process daily. Ask yourself, what did I do well? What can I improve? What patterns am I missing? Just as financial compounding builds wealth over decades, consistent reflection compounds wisdom and decision-making skills. Step 7. Develop emotional intelligence. Buffett rarely allows emotion to dictate action. Far from being innate, emotional discipline is cultivated through awareness, patience, and deliberate practice. The more people react impulsively to fear, greed, or social pressure, the more disciplined thinkers can capitalize. Not only does emotional intelligence reduce costly mistakes, but it compounds influence and negotiation power over time. This is about more than controlling anger or impatience. It's about making decisions that serve long-term advantage, not short-term impulses. Step 8. Apply the mantra repeatedly. The best stock you can buy is always yourself. Say it aloud every morning. Repeat it before critical decisions. Reinforce it during reflection and learning sessions. Far from being theoretical, this statement is actionable. It guides daily routines, habit formation, learning focus, and risk-taking. You have a choice. You can invest externally first, or you can invest internally first. The compounding power of self-investment surpasses any external asset. Step 9. Leverage learning for action. Knowledge and skills are useless if they remain theoretical. Buffett doesn't just read or study. He applies insights in investments, partnerships, and personal growth. Far from being passive, action compounds results. Not because action guarantees outcomes, but because disciplined action built on knowledge magnifies returns. Whether you like it or not, action transforms preparation into opportunity. Step 10. Commit to lifelong growth. Buffett never stops learning. He doesn't see education as finite. Far from being occasional, growth is a lifelong habit. You might think you've reached mastery. In reality, continuous improvement is what separates the average from the extraordinary. Far from being optional, the habit of self-investment compounds returns over decades. Every hour, every book, every reflection, every skill practiced is interest accumulating in the bank of your life. Let's summarize your actionable takeaways from this chapter. Read relentlessly. Knowledge is compounding capital. Develop critical skills. Ability amplifies opportunity. Seek mentorship. Leverage experience to accelerate growth. Build disciplined habits. Compounding occurs daily. Invest in health. Mind and body enable execution. Reflect consistently. Mistakes and wins are learning capital. Cultivate emotional intelligence. Decisions must be deliberate, not impulsive. Repeat the mantra. The best stock you can buy is always yourself. Take action. Knowledge without execution is wasted potential. Commit to lifelong growth. Compound skills, habits, and knowledge over decades. You have a choice. You can chase external validation, short-term gains, or passive accumulation. Or you can invest first in yourself, your skills, knowledge, habits, and health. You don't need anyone's permission to grow. You don't need approval from peers or the market. Chapter 8. Cut the noise, amplify focus. You have a choice. Every minute you spend on distractions is a minute of lost opportunity. That's the key. Warren Buffett, one of the most successful investors in history, built his fortune not by chasing trends, but by eliminating noise and concentrating relentlessly on what matters. He has said, the difference between successful people and really successful people is that really successful people say no to almost everything. Not because opportunities aren't valuable, but because undisciplined attention is a silent tax on your time, energy, and results. Buffett structures his life intentionally. Far from being reactive, he carefully curates meetings, correspondence, and daily activities. You don't need their permission to simplify your schedule. You don't need external approval to prioritize what is most important. Whether you like it or not, attention is the only non-renewable resource you truly own. You might think multitasking is efficient. In reality, it dilutes your impact and compounds risk. Focus is freedom. Noise is a tax you can't afford. Step 1. Identify your highest value activities. Buffett spends the majority of his time reading, analyzing investments, and thinking critically. He minimizes meetings that don't create leverage. Far from being arbitrary, this is strategic prioritization. You have a choice. You can allow your calendar to dictate your actions, or you can dictate your calendar to serve your goals. Not only does identifying high-value activities streamline your day, but it also amplifies your ability to create meaningful outcomes. Repeat to yourself, focus is freedom. Noise is a tax I can't afford. Step 2. Eliminate low-value commitments. Buffett famously says, "You can't do a good job if your job is all over the place." Far from being rigid, this principle allows him to devote deep mental energy to fewer, more important decisions. Not because minor tasks are worthless, but because your attention is finite. Whether you like it or not, time spent on distractions compounds into lost opportunities. You have a choice. Say no selectively. Protect your focus relentlessly. Step 3. Apply selective attention in decision-making. Buffett evaluates investments with deliberate attention. He reads reports, studies leadership, and models long-term outcomes, ignoring short-term chatter, media noise, and market hysteria. The real question is not what opportunities exist, but which deserve your disciplined focus. Far from being passive, selective attention multiplies leverage. The more you ignore distractions, the more your impact grows. Not because you avoid work, but because you concentrate on high-leverage actions. Step 4. Create mental space for reflection. Buffett spends significant time thinking, deliberately and without interruption. He doesn't let his mind be occupied by trivial matters. Far from being indulgent, reflection is a strategic investment. You might think constant activity is productive. In reality, unstructured business is costly. You have a choice. Schedule time to think, analyze, and strategize. This is about more than quiet contemplation. It's about compounding intelligence through focused attention. Step 5. Limit exposure to noise sources. Buffett avoids unhelpful social media, sensationalist news, and unnecessary meetings. Far from being antisocial, he selectively curates input. The more everyone talks, the more he focuses. Not because other perspectives are irrelevant, but because indiscriminate input dilutes judgment. You don't need anyone's permission to protect your mind. You don't need validation to remove distractions. Noise is a tax you can't afford. Ignore it. Step 6. Practice deliberate concentration daily. Buffett reads 5 to 6 hours a day, uninterrupted, absorbing knowledge and identifying patterns. Far from being passive, this discipline compounds skill and judgment over decades. You might think small, fragmented learning is enough. In reality, depth, repetition, and focus create the advantage. Not only does deliberate concentration build intelligence, but it also enhances clarity under uncertainty. This isn't the end. It's the beginning of mastery over your attention. Step 7. Prioritize relentlessly. Buffett reportedly keeps a top 25 list of goals, then focuses exclusively on the top 5, avoiding the rest until the top priorities are achieved. Far from being a gimmick, this principle ensures energy is concentrated where it produces the highest returns. You have a choice. You can scatter effort across trivial tasks, or you can channel energy into a few high-leverage actions. Just as compound interest multiplies wealth over decades, focused energy multiplies outcomes when applied consistently. Step 8. Use routines and systems to reduce decision fatigue. Buffett is known for his simple lifestyle: few clothing choices, structured schedule, and predictable routines. Far from being mundane, this creates mental bandwidth for high-value decisions. Not because small decisions are trivial, but because minimizing low-value choices preserves focus for strategic action. You might think variety is stimulating. In reality, too much choice fragments attention. Focus is freedom. Noise is a tax you can't afford. Step 9. Apply focus to relationships. Buffett invests deeply in long-term partnerships, mentors, and family relationships. Far from trying to please everyone, he prioritizes relationships that matter. The more everyone talks, the more he listens to a select few. Not because others are unworthy, but because influence and impact compound where trust, alignment, and shared vision exist. You have a choice. Focus on relationships that matter. Ignore the noise of shallow interaction. Step 10. Reinforce the mantra audibly and mentally. Repeat. Focus is freedom. Noise is a tax I can't afford. Say it before meetings, reading, and decision-making. Far from being abstract, this phrase guides every choice you make. Protect your attention. Prioritize high-value work. Remove distractions. You have a choice. Whether you like it or not, the world will compete for your attention. Choose wisely. Let's summarize your actionable takeaways from this chapter. Identify high-value activities. Focus on actions with the largest impact. Eliminate low-value commitments. Protect your time and energy. Apply selective attention. Concentrate on what truly matters. Create reflection space. Allow uninterrupted thinking for clarity. Limit exposure to noise. Reduce distractions from media and trivial input. Practice deliberate concentration. Read, study, and think deeply. Prioritize relentlessly. Focus on top goals first. Use routines to reduce decision fatigue. Free bandwidth for strategic action. Focus relationships strategically. Build influence where it compounds. Reinforce the mantra. Protect your attention relentlessly. You have a choice. You can let distractions dictate your results, or you can take control of your attention and amplify focus. You don't need anyone's permission to simplify, prioritize, or concentrate. Focus is freedom. Noise is a tax you can't afford. Far from being optional, mastering focus compounds every skill, habit, and opportunity you pursue. Chapter 9. Avoid the fatal trap of seeking approval. You have a choice. Every decision you make can be influenced by the desire for approval or by independence of thought. That's the key. Far from being trivial, the need for validation can silently destroy wealth, influence, and opportunity. Warren Buffett, one of the wealthiest and most successful investors in history, has repeatedly demonstrated that independence is the currency of long-term success. He has said, "Be fearful when others are greedy, and greedy when others are fearful." Not because he enjoys contrarian thinking, but because following the crowd, seeking approval, can be the fastest path to mediocrity and loss. Buffett rarely follows trends, public opinion, or media hype. Far from being stubborn, this is strategic self-protection. You don't need their permission to ignore conventional wisdom. You don't need social validation to pursue what you know is right. Whether you like it or not, the moment you prioritize approval over judgment, you compound risk and reduce opportunity. Approval is a cost. Independence is a profit. Repeat it aloud. Let it echo in every financial, professional, and personal decision you make. Step 1. Recognize the cost of approval. Seeking validation diverts attention from high-value activities. You might think pleasing everyone will create leverage. In reality, it dilutes focus, compromises integrity, and slows growth. Buffett ignored Wall Street hype, media speculation, and public pressure when making investments in Coca-Cola, American Express, and Geico. Far from being reckless, he calculated value and acted independently, not because he wanted to prove others wrong, but because approval is an expense you can't afford to pay with your time, money, or judgment. Step 2. Build a personal decision framework. Buffett evaluates businesses, investments, and strategies according to consistent criteria, long-term value, competent management, and margin of safety. Far from being reactive, he follows discipline over crowd psychology. The real question is not whether others agree, but whether your logic and analysis hold up under scrutiny. You have a choice. You can chase applause, or you can chase results. The more important issue is whether your decisions compound advantage over decades, not whether they earn instant praise. Step 3. Practice contrarian thinking deliberately. Buffett often invests in unpopular sectors or companies precisely because others overlook them. Far from being contrarian for its own sake, this is calculated independence. You don't need their permission to be different. You don't need consensus to act decisively. Not only does contrarian thinking reduce competition for opportunity, but it magnifies returns when the crowd finally catches up. Repetition equals retention. Approval is a cost. Independence is a profit. Step 4. Separate ego from decision-making. Seeking approval is often rooted in ego. Far from being a moral failing, ego-driven decisions are the silent wealth killer. Buffett keeps his ego in check by focusing on facts, logic, and long-term outcomes. You might think that public recognition validates skill. In reality, it can blind you to risk and distort judgment. You have a choice. Make decisions based on value and integrity, not applause. This is about more than confidence. It's about financial and personal survival. Step 5. Ignore noise from peers, media, and social networks. Buffett consistently ignores sensational news, analyst hype, and trending investment fads. Far from being isolated, this protects his mental capital. Whether you like it or not, the crowd is often wrong, especially when it comes to money. The more everyone talks, the more Buffett focuses. You don't need anyone's permission to tune out noise. Reaffirm, approval is a cost. Independence is a profit. Step 6. Measure success by results, not praise. Buffett evaluates his life and investments by long-term outcomes, not popularity. Far from being arrogant, he values substance over appearance. You might think recognition signals correctness. In reality, consistency, patience, and discipline compound real results far more reliably than applause. Not only does focusing on outcomes reduce distraction, but it reinforces self-reliance and rational decision-making. You have a choice. You can seek validation from others or rely on your own judgment. Step 7. Practice saying no strategically. Buffett's success is built on selective opportunity. He says no to many investment ideas, business proposals, and social distractions. Far from being obstinate, saying no preserves bandwidth and focus for the opportunities that truly matter. Just as compound interest multiplies wealth over decades, selective no's multiply effectiveness over time. Not because you are rejecting others, but because you are protecting your highest value actions. Step 8. Reinforce independence through reflection. Buffett routinely reviews past decisions to understand why they succeeded or failed. Far from being self-congratulatory, this practice strengthens judgment and reduces reliance on outside validation. You have a choice. Reflect on your decisions honestly without concern for what others think. If we don't learn to rely on our own assessment, then we risk repeating mistakes motivated by social approval. Step 9. Cultivate a network that values integrity over flattery. Buffett surrounds himself with Charlie Munger, trusted business partners, and competent managers who challenge him constructively. Far from being closed-minded, this network amplifies independent thinking. You might think having many yes-men is safe. In reality, true growth comes from accountability and reasoned critique. Approval from unqualified voices is a cost. Counsel from skilled, independent thinkers is an asset. Step 10. Repeat and internalize the mantra. Approval is a cost. Independence is a profit. Far from being abstract, this phrase guides daily behavior, investment decisions, and long-term planning. Whether you like it or not, the world will attempt to influence your decisions. You have a choice: follow the crowd or follow reasoned independence. You don't need their permission. You don't need their applause. Protect your judgment. Amplify your independence. This is about more than ego. It's about wealth, freedom, and long-term security. Let's summarize your actionable takeaways from this chapter. Recognize the cost of approval. Avoid letting validation dilute decisions. Build a personal framework. Prioritize logic, discipline, and long-term outcomes. Practice contrarian thinking. Identify overlooked opportunities. Separate ego from decisions. Avoid emotional bias and social pressure. Ignore noise from peers and media. Focus on meaningful inputs. Measure success by results. Substance over recognition. Say no strategically. Preserve focus for high-value actions. Reflect independently. Learn from experience without external judgment. Curate a constructive network. Surround yourself with accountability, not flattery. Internalize the mantra: approval is a cost. Independence is a profit. You have a choice. You can chase applause, follow the crowd, and let social pressure dictate your decisions. Or you can act independently, trust your judgment, and compound wealth and freedom like Buffett. Far from being optional, independence is the prerequisite for long-term success. Approval is a cost. Independence is a profit. Repeat it. Live it. Protect your decisions. Chapter 10. Act, adjust, and compound your advantage. You have a choice. Every moment you delay action is a moment of lost opportunity. That's the key. Knowledge without execution is like a blueprint locked in a drawer. It has no power until applied. Warren Buffett, one of the most successful investors in history, didn't just read endlessly about businesses and markets. He acted. He executed. And when circumstances changed, he adjusted intelligently. He has said, "The chains of habit are too weak to be felt until they are too strong to be broken." Not because discipline alone guarantees wealth, but because action compounded over time is unstoppable. Buffett's wealth was not built on theory, speculation, or the desire for immediate approval. He took small, calculated steps and let compounding magnify their impact over decades. You don't need permission to act. You don't need the crowd's agreement. Whether you like it or not, waiting for perfect conditions is a trap. Start today, adjust tomorrow, compound forever. Repeat this mantra until it drives every decision, every strategy, every investment you make. Step 1. Take decisive action. Buffett doesn't hesitate indefinitely, paralyzed by analysis. Far from being reckless, he moves when he has sufficient knowledge and a clear margin of safety. You might think waiting ensures perfection. In reality, it ensures lost opportunity. You have a choice. Act on what you know. Adjust on what you learn. The more important issue is not speed for its own sake, but disciplined, timely execution. Not because impulsiveness is good, but because indecision is costly. Step 2. Start small, scale smart. Buffett often begins with modest investments or incremental actions before committing fully. This strategy allows him to test assumptions, learn, and refine. The real question is not whether to act boldly immediately, but how to start in a way that preserves flexibility. Just as compound interest multiplies small sums into enormous wealth, small smart actions compound into massive results over time. You don't need grandiose moves to build an empire, just consistent, deliberate steps. Step 3. Adjust based on feedback. Buffett monitors businesses, financial reports, and market trends constantly. Far from blindly holding positions, he adjusts when the underlying facts change. You might think adjustment signals failure. In reality, adaptation signals intelligence. You have a choice. You can stubbornly cling to outdated plans, or you can act, learn, and adapt. That's the key. If we don't adjust, then we risk compounding mistakes instead of advantage. Step 4. Compound relentlessly. Buffett understood early that time and consistency create exponential growth. Far from being dramatic, this principle explains why his early investments in companies like Coca-Cola, American Express, and Apple multiplied into extraordinary wealth. You might think instant results are essential. In reality, patience, discipline, and repeated action outperform short-term gains every time. This is about more than money. It's about freedom, influence, and leverage. Repeat, start today, adjust tomorrow, compound forever. Step 5. Build routines that reinforce action. Buffett reads 5 to 6 hours per day, consistently, absorbing knowledge and spotting patterns. Far from being indulgent, these routines make execution faster and more accurate. Not because routines guarantee success, but because disciplined habits eliminate friction between knowledge and action. You don't need anyone's permission to structure your day. You don't need approval to optimize for results. The more consistent your routines, the greater the compounding effect. Step 6. Focus on high-leverage actions. Buffett doesn't scatter effort across trivial tasks. Far from being rigid, he prioritizes activities that generate outsized returns over time. You might think every opportunity deserves attention. In reality, only a few actions truly compound advantage. Not only does prioritizing reduce distraction, but it multiplies impact when executed consistently. You have a choice. Act where leverage is high. Ignore the rest. Step 7. Embrace risk intelligently. Buffett knows that risk is not inherently negative. Mismanaged risk is the enemy. Far from avoiding it blindly, he analyzes risk carefully and acts when the odds favor success. You don't need social approval to take smart risks. You don't need consensus to protect upside. The more calculated your actions, the greater the compounding benefit over decades. Repetition. Start today, adjust tomorrow, compound forever. Step 8. Review, reflect, and refine. Buffett constantly reviews investment performance, decision-making, and personal discipline. Far from being self-congratulatory, this reflection identifies opportunities for adjustment and improvement. You might think reflection slows action. In reality, reflection accelerates compounding by reducing repeated mistakes. This isn't the end. It's the beginning of mastery over execution. The more you refine, the greater your advantage. Step 9. Internalize accountability. Buffett takes full responsibility for his decisions, whether they succeed or fail. He views execution as a personal commitment. You have a choice. You can wait for permission, validation, or favorable circumstances, or you can act decisively and own the results. Not because external approval is irrelevant, but because your judgment and actions compound faster than anyone else's opinion ever could. Step 10. Reinforce the auditory mantra daily. Start today, adjust tomorrow, compound forever. Far from being abstract, this phrase guides every investment, business, and personal decision. Repeat it before meetings, before strategic planning, before financial choices. Execution is the differentiator between ambition and achievement. You have a choice. Act now. Adjust as you learn. Compound relentlessly. Let's summarize actionable takeaways from this chapter. Take decisive action. Knowledge without execution is wasted potential. Start small, scale smart. Incremental steps compound into massive results. Adjust based on feedback. Adapt intelligently without fear of change. Compound relentlessly. Time and consistency are your allies. Build routines that reinforce action. Structure reduces friction and multiplies output. Focus on high-leverage actions. Prioritize tasks that create outsized returns. Embrace risk intelligently. Avoid reckless moves. Manage calculated risks. Review, reflect, and refine. Continuous improvement compounds skill and results. Internalize accountability. Own your choices and results fully. Repeat the mantra. Start today, adjust tomorrow, compound forever. You have a choice. You can let knowledge sit idle, waiting for perfect conditions. Or you can act decisively, adjust intelligently, and let compounding multiply every advantage. Far from being optional, execution is the engine of wealth, freedom, and influence. Start today. Adjust tomorrow. Compound forever. You don't need their permission. You don't need approval. You have everything you need within your choices and actions. You've learned to think like Buffett, ignore the herd, master patience, find true value, manage risk, build influence, invest in yourself, cut distractions, avoid approval traps, and, finally, act with discipline and compounding power. Far from being theoretical, these principles transform knowledge into freedom, influence, and lasting wealth. This isn't the end. It's the beginning of your journey to multiply advantage in every area of your life.